Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. I am your host or your co-host, Ryan Henderson, and I am joined as always by Brett Schaefer. We have got a lot on the docket today. Quick reminder, we do these shows live on YouTube on Thursdays at 9:30 Pacific time, 12:30 Eastern time. So if you look up Chit Chat Stocks on YouTube, you'll find us, and we start these shows, like I said, at 9:30 Pacific time. And you can ask questions, and we get a lot of questions throughout the show. So we'll take those as we go. If not, keep listening to us in podcast format. We love that too. We have a ton of stuff on the agenda today. We have a new theme or a new segment that we're going to do on a recurring basis. Roaring Kitty, the man himself, might be back. TBD. There may be a bit of a twist in there that I wouldn't say I discovered, but people are starting to speculate about. And then we're going to be talking about 10 high growth software stocks that just hit their 52-week lows. It seems like software Mageddon is coming around thanks to Salesforce's rough report, and people are starting to call it cyclical business, maybe. So we're going to be talking software as well. What topics do you have for us this week, Brett?
Yeah, I got Lululemon. They reported earnings, which is fun. I should say, hey, welcome in everyone. My name is Brett Schaefer as well. I join every week. Yes, Lululemon earnings. We've been talking about them this year. It's been quite interesting with their drawdown. Interesting report. We'll talk about that. And I forgot. I did the notes yesterday, but I don't even remember what I did. Let's see. Pull it up here. Oh, Mexico got a new president. I know we like following Mexican stocks, and that's been a tricky country, so that could be fun. NVIDIA hit $3 trillion market cap, and there was this isn't really a topic, but we don't need to describe the photo, Ryan, but did you see the photo for those that are in the know?
Hard to miss.
If that's not an indicator of a blow off top, right? That's but yeah, I'm loading up stuff here. Ryan seems to be needing to do something as we start off here. All right, I'll just keep going as we hopefully people join in here. I'm kind of loading up the thumbnail, but yeah, we got 10 high growth software stocks that just hit 52-week lows. Stuff like Snowflake, Atlassian, Veeva Systems, MongoDB, Dropbox, stuff that's been pretty interesting. I mean, these ones have been growing for honestly quite a bit. All right, Ryan's back here. He had a little at-home snafu or something. I'm going to be
didn't
tweeting
want to
out the
ruin the
link here,
audio.
so Ryan, why don't you lead into the first topic? Maybe Lululemon earnings?
Well, before we do that, I want to talk about our friends, our sponsor, public.com. If you trade options, you've got to ask yourself, why wouldn't you choose an options trading platform that puts investors first? At public.com, there are no commissions or per contract fees. And more importantly, it is the only platform where you can earn a rebate on every single contract traded. That means you can save on your options trading costs and keep more of your capital in play. Whenever you trade options on public, your savings are automatically applied. So don't change your strategy, change your platform, and see the difference in your bottom line. No commissions, no per contract fees, and it's the only options trading platform where you can earn a rebate on every contract traded. That's public.com. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. All right. I want to talk. Should we do our new theme?
Yeah, why don't Lululemon first? That seems to be one that people really interested in. I think can tie people in for the most catchy one. And then and then we can do the theme after that.
Sure thing. Okay. You want to pull up here? I'll pull up some numbers. You can go through the actual report while I screen share here. Brett?
Yep.
Yeah, you want to go through the numbers?
Oh, sorry, I was tweeting out the link. I don't know if I thought you said you were gonna go through the numbers.
No, I'm gonna share some numbers, share some of the charts and stuff, and
yeah. Sorry, I was in the middle of a tweet. I gotta send this out to make sure people want to join us here.
Why don't I talk through the numbers? So
yeah.
All right. Lululemon, from everything I saw, looked like a pretty good report. I'm pulling things up right now, and I believe 10% top line revenue growth, slight margin contraction, if I'm not mistaken. But moral of the story is that they announced a new share buyback program, $1 billion authorization on top of already $700 million authorization. So $2 billion roughly. I have a ton of sirens going in the background here, so I
Yeah,
apologize for the audio.
I can't hear anything. So
It's gonna get louder. Here, just take over and talk Lulu earnings.
okay, all right, Ryan. Give me I'm multitasking this morning as I'm trying to get the links out here. But let me go through, pull up my notes. All right. So essentially, what I saw was about as what you'd expect. America's revenue, which is North America, Canada, and the United States. That's the two markets they've been in for the longest time. I believe they were founded in Vancouver, so actually probably got just as much market share in Canada as the United States. That segment only grew 3%, but China grew 45%, international grew 35%. And then we saw a slight divergence between men's revenue and women's revenue. Men's revenue grew 15% year over year, women's growing under 10%. Nothing super crazy on the margin front, seemed pretty standard. It's not like they've had to increase marketing or promotions or anything like that to get to sales. I didn't see anything, at least when I pulled up any of the on the numbers there. The question I have is, it seems like people are actually right that, and they probably saw it in the alt data. I guess that's stuff that I don't really look at for, the Americas segment for women has slowed down quite a bit. And it's something that they talked about on the call, I believe, where the they said that they were not executing as good as as good as they thought they should be. It seems like they've lost a little bit of market share to those other people like Aloe and all the other upstarts out there. The question is, can they fix it, or is this a permanent change to the industry where it's just going to be much more competitive going forward, going after this lucrative women's business in North America for what do you call it, athleisure, the entire industry?
Yeah, I don't know. There was obviously, if the idea here is that the growth is coming from China, it's a very different investment. And it seems like there has been the North America slowdown in general. Men's is still growing okay. It's outpacing women's a little bit, but still not the kind of growth you would hope to see out of this brand in North America. So for me, I'm kind of glad I didn't touch it because I mean, well, the stock jumped. So to all you with a psychological long or anyone that's actually long, Lululemon, congrats. But it's a very different investment for me now. You're looking at potentially, maybe it's just a bad quarter, but maybe a lower growth business in North America and something where you're playing like the growth in China, which that's just not an investment I love.
It's harder. It's harder, yeah. And that market's more tricky, I guess, for for someone that lives in North America. Living in North America, I can tell, given some of the data, just given the anecdotes out there, being living here, whether the business is still sound. And yeah, I don't know. The question we have here. Okay, we have one from Tyler that says, "Do you guys think Lulu is just a North America consumer slowdown?" Possibly. I mean, we've seen a lot of retailers, a lot of consumer brands, even across restaurants, whatever, where they've had really bad comp sales, tough comp sales this first part of this year. Maybe that's part of it. But I think if you read all the articles out there, you just look at what's happening with the competition out there. There's so many, whether how small they are or not, if there's dozens of these smaller athleisure companies out there, that can add up to being a competitive threat. And the thing is, Lululemon's, it's they're still doing fine. I mean, it's not like North America revenue is going down, but I wonder how or whether they can take the next step to become, quote unquote, the Nike of that niche of athleisure, or it's going to be more competitive than we think. I mean, look, it's still profitable, still a good business. You're not going to be you're not going to have a monopoly in athleisure, but do you have this is the question, do you have confidence that North America revenue can grow significantly? I don't really know. Like, how aggressive is Allo going to be? How aggressive are all these other people going to be? Are we seeing a change in just trends that are unpredictable, right? Right? I mean, I don't know anything about no, don't know much about this, but people seem to be wearing baggier clothes now. That could impact things for Lulu for at least a couple of years. So it's tough. The stock is at, I think, a trailing earnings ratio of about 30. Not sure about forward, but it's not like this is an undemanding valuation or earnings multiple. It's not like it's um, a company that's fallen down to like 13 times earnings. We're still at about the market multiple, which I think is using the market multiple might be not not good right now. Good just because it's so high. But what are your thoughts on that, Ryan?
Yeah, I mean, it looks cheap just because relative to its history, it's always been more expensive.
Right.
And it's nice to post a little chart here and there where it's like, this is the cheapest it's ever been. But I think the outlook's different than it's been in the past. You're looking at really a business that has a lot of competition in North America. It's seen some international growth. It's investing internationally. I shared a chart there of mainland China stores and operations, and it's just been growing rapidly. That's the fastest growing market and where they're putting a lot of their resources. So I don't know the Chinese market well at all. I definitely don't know it for apparel. And yeah, like you said, it's not like this is trading at some low teens or even single digit earnings multiple. It's not been bombed out. It's in one of its biggest drawdowns, but still it's fairly expensive. And I think I'm going to stand by the fact that I don't want to touch apparel businesses ever.
Yeah, it's a tough one, and stock's done pretty poorly over the last 5 years. At least I think. You can actually maybe pull it up, but yeah, I think that's pretty much it. Nothing really exciting on that one. We'll see. People might be right. People might be wrong. I have no clue. Stock might do well, but not the game we like to play. All right, let's hit the
14%
news segment. What?
total return over the last 5 years has been 14% annualized.
Over the last 5 years. Maybe it was 3 years I was looking at where it's been tougher. But I mean, that's pretty good still.
Yeah, it's not bad. The
Not bad.
Let's talk about some other fun stuff. Also, apologies to everyone for the chaotic start to the show, but we're rolling now. So, what do we want to discuss? Roaring Kitty?
Yeah, we can do that one. Or maybe yeah, whatever one. You have three on yours. Pick whatever one you want.
All right. So, Roaring Kitty, I'm going to pull this quotation from, I think it's a Bloomberg article. It says, GameStop shares surged after the Reddit account that drove the meme stock mania of 2021 posted what appeared to be a $116 million position in the video game retailer. The June 2nd screenshot posted by Keith Gill, who goes by a profane handle involving the phrase deep value on Reddit, shows a stake of 5 million shares with an average cost basis of $21.27 apiece. A position that large would make Gill one of the company's 5 biggest investors and is more than 6 times the number of shares his account showed in April 2021. There's also there was a screenshot which also included 120,000 call options worth $66 million due to expire on June 21st. They couldn't verify that was Gill, but basically it somewhat coincided with, it seemed like it was Gill. Here's my question though. Keith Gill never had that much money. Even after his gains from GameStop, he never had that much money. I mean, this amounts to like multiple hundreds of millions of dollars. So unless he got some money in between then, maybe from that movie or something, it seems
Right.
unlikely that happened. So there is some suspicion that he sold his account. He sold his Twitter account. This is not him placing the trades.
Or was hacked. Let's just say we can't accuse him of selling it if he doesn't know what's going on, or maybe But the thing is, I feel like he would figure it out if it was going on. Even if he was a hermit living in the woods, he would probably figure out this at this point. It's interesting because we don't know, and we have a question here that says, oh yeah, Tyler asked the question that you asked here. Do you think Gil sold his social media profiles? Do you guys think the brokerages should ban him? Do you guys think Gil will get prosecuted? I think they should just investigate what happened.
So,
Given that there's a digital trail here, they can figure out and do an audit of who is actually doing all these things.
yeah, but is it illegal?
Well, it depends on what actually happened. That's what I mean. We don't know what happened.
So, here's my suspicion. You're Keith Gill. You just made a once in a lifetime bet, really. Now, you know that if you post some position, you'll have a whole bunch of people follow you in, but you just went through like the ride of a lifetime, basically, where you own GameStop, got a whole bunch of garnered a cult like following around it, and made a ton of money in the process. Less money than what's posted here. Are you really going to risk your what looks like a good chunk of your personal wealth on weekly, maybe 3-week call out of the barely in the money call options?
Right.
That seems a little unlikely. That doesn't seem like something I would do if that's how much money I had.
Yeah, but you
And
don't go to the roulette table, Ryan.
yeah, but he didn't either.
Hey, last time basically it was sort of after the
No, he
first
was
little.
just owning it for like the dividend play. I
Well,
mean, it was like good analysis. He got to like he wasn't just buying out of the, if I remember correctly, he had a position. It wasn't out of the money call options, and he
yeah,
did thorough analysis and owned it for a while.
yeah, but it did hold on, and he really embraced the meme stuff after a while. But I agree, it's probably not him. It's interesting because I don't know whether if it's legal or not, but if someone hacked his account, misled people, bought these options, did a pump and dump by posting the screenshots, should it be legal?
You would
I
have to
don't
be a
know.
very wealthy hacker.
Yeah, I'm not sure exactly what.
I think it's more likely. I guess it could have been a hacker, but it seems like if I were a fund, up and coming fund, and I knew I could buy a an account that would allow me to guarantee that my trades worked by posting a reverse Uno card on some Twitter account. That seems like this feels like a fund.
Does it? Feels like a crypto bros that have way too much money. I think if he did all this stuff and it's just him, it's clearly not illegal. He's just posting some memes and people are following him, and it's not wrong to say I own this and follow the trades. But if someone manipulated that account or like a screenshot and said, um, basically like they don't actually have that position, maybe they wanted it to seem like it's a huge position because that can drive more attention and stuff like, oh, he has $100 million position or whatever it was. And if it wasn't them, or if it wasn't actually him, I don't know if that's illegal or not by the letter of the law, but it does seem to me a bit to be extremely misleading, and there should be some investigation to figure out what happened because there's people on the other side of these things that can get hurt, and you want honest markets as much as we possibly can.
Okay, let's move to a new topic. I don't know. Roaring Kitty, if
We
this
don't know
is
yet.
really you,
Yeah.
good for you, I guess. But why would you risk all your wealth? It just doesn't seem like that's got to be all his wealth and then some.
Yeah, it's interesting. We'll see. But if you got to somewhere playing at the roulette table, if you got became a millionaire playing at the roulette table, sometimes you just love playing the game again. But yeah, do you want to hit your new topic, that your recurring segment that you're planning on doing here with small and micro caps?
Sure thing. So, posted a thread this week. Basically, it seems like high growth software stocks are kind of getting bombed out right now. A number of them have hit their 52-week lows. If you look on the 52-week low list, just look that up on Google, you're going to see a ton of software stocks. And so I'm going to go through some of these and just talk through some of the ones that have all hit their 52-week lows in the probably basically like the last week. And let's see if any of them seem attractive. So I'll kick things off with Snowflake. They're the first one here. I'm doing this in order of largest market cap to smallest market cap.
Yep, and I'll share the screen for video listeners on, I believe we do it on Spotify too, but you should be able to see some of this stuff on the screen share.
Yeah, and so Snowflake, they help get rid of data silos. It's a data warehousing platform, and it's really done a good job growing with kind of the cloud market overall. So their 5-year revenue CAGR, or the annual growth rate for their 5-year revenue, 96%. It's down 66% from its highs, and it's got a market cap of $46 billion. The sentiment on this one seems horrible. Everyone seems to think that this is like kind of fading away, I guess, or maybe people are just taking victory laps because it used to be one of the most expensive stocks around. Honestly, I don't know the market for Snowflake very well, but it's still a fairly demanding multiple. It's not like cheap in the
Well, it's
traditional sense.
unprofitable. Look at this. I mean, you
Sure.
see that's operating income. It just keeps moving in the wrong direction.
They do have plenty of cash to burn, which
Great. Let's just be unprofitable then.
I mean,
What's that price to sales?
it doesn't make sense. If they have the money to invest, I don't see why they would. If they think they're generating a good return out of their investments that they're deploying, it makes sense for them to do it, right?
Sort of, but I think most good businesses are all usually profitable once they hit. I'm sure this is a considerable size. I mean, if you're that good of a business, I don't really see why you can't be profitable at this scale. And if you're not, well, okay, what are those operating expenses that are keeping you growing? But if they keep growing this fast, I mean, here's what's crazy, Ryan. Look, remember Snowflake? Price to sales 120 when it came public. I guess now it's down to 15, but that's some multiple compression right there. Maybe the opportunity's there because everyone's gotten washed out. I don't know.
How much cash does it have?
Let me check. Sometimes it's tough to find that since the definitions here. Total cash and short-term investments, $3.5 billion. I'm guessing they do a lot of SBC, so the actual cash flow is not that bad. So that's not the concern here. I bet the concern is share dilution, which let's check her out. Total shares outstanding. Growing at about 4% a year. Yeah. That's a headwind. That's a headwind right there.
But 96% revenue growth. Now, I don't like situations where we just say, but look at the revenue growth. But 4% dilution and 96% revenue growth, the revenue growth per share is still quite strong. And in theory, if they can get to a reasonable operating margin, it seems like they're probably going to. It's hard to imagine them not working out if they start to see some operating leverage. The second one I'm going to talk about, though, it's Atlassian. This is Australian-based company here. They are a project management software system. They're most famous for Jira. It's not something I've worked with before, but it helps connect technical and business teams so that they can plan and track and manage everything together. 36.5% annual revenue growth for the last 10 years. Pretty staggering. Drawdown, it's down 65% from its highs. It's got a $42 billion market cap. What do you think about this one, Brett?
Let's see. I'm looking at operating income. If I look at all these, Ryan, and they don't generate any earnings, I'm going to be mad because what are we doing with the software companies? But I know Dropbox actually generates a profit. I was going to look at I'm assuming they have high gross margins. I know we're using price to sales and that's a crime, but if I know the gross margins are high and they're not profitable, think it's a decent proxy. We're at a price sales of about 10. I mean, what was that growth rate again on revenue? How fast are we growing?
37% over the last decade annually.
Okay, well, what about recently?
You got it right there in front of you.
Yeah,
Let's see here.
let's see. Since June 2021, 32%, pretty good. Yeah.
Here's the thing about, I think you might be looking at some of these wrong, to be honest. We're going to get into some of these human capital management software where it's hard to distinguish between one another. But with businesses like Atlassian and Snowflake, they've built a product and a business that is durable. Like, it matters to customers, it seems. Now, I'm not in the nitty gritty. I don't really understand the customer value prop that much, but from everything I've read, it seems like the customers love this product. These are the ones where if they find religion, or if an activist CEO comes in, or you get, or not an activist CEO, activist brings a CEO in, or an activist just joins the board, whatever, and you get a Salesforce-like situation, I think you can start to see serious operating leverage in these businesses, and you're probably going to get really strong returns.
Possible. But let's say, okay, you're at a price sales of 10. Let's say they can get to best of the best operating margins of 40%. What are we at? A PE of 25? I mean, yeah, that can work if the growth rate continues, right? But I'm betting on Microsoft level margins. I don't know if that's a bet I want to make at a price sales of 10. Now, if it's down to 4 or 5, I mean, I think that's a different story. But someone like Snowflake or Atlassian, these valuations don't really attract me, especially because it's not a sector I have any sort of circle of competence on.
Okay, let's move to the third one here. Veeva Systems. Veeva is a leader in cloud-based software for the global life sciences industry. I remember hearing basically a description on the details of the business, and essentially it sounds like this really kind of powers a lot of the pharmaceutical companies. And I'm not 100% sure what the competition looks like in that space, so I'm not going to talk too much about it, but really strong growth rate over the last 10 years, 30% annual revenue growth, $28 billion market cap. It's down just under 50% from its highs. You can go through some more of the numbers here. I remember they came public, I want to say in like 2015 or 2016. Could be wrong there. But
Ryan, they're growing revenue at 30%. For anyone that had the share screen there, and guess what? They're actually generating an positive operating earnings. This one, yeah, they went public a while ago. They've been public for at least 10 years, I think. And I believe, yeah, I don't know this company that well, but I believe it's like Salesforce, but for specifically biotech. And that could be a little bit different. I think someone described it as something of biotech. So it's one of those software platforms, but specifically for that industry, maybe pharmaceuticals as well, which makes sense given that's a niche that has a lot of interesting things that you want. That's particular to that one. Let's look at price to sales. Hey, whoa, okay, 11.8, not terrible for a company that's this profitable, growing that quickly. Yeah, this one I mean, given the fact that they're able to grow more efficiently than Atlassian or Snowflake, I'm more attracted to this one. And because they're in a niche, I wonder if they can have some sort of a better competitive advantage where these broad-based platforms there's another competitor that comes out every month out of Silicon Valley.
yeah, it excites me. I worry that maybe this is closer to the maturity than some of the other businesses. Maybe there's ways to upsell, but being that they are so niche, and if you look at the customer count on the segments and KPIs, I imagine it's
I'm not
maybe
sure if they
tapered off
have
a little
that.
bit.
Do they?
They don't do the customer count.
They don't do customer count. But Ryan, let me ask you a question. Do you think biotech and pharmaceuticals will be a larger industry in 10 years or a smaller industry? I'd say almost definitely larger.
Yeah, definitely larger. Okay, let's move to the fourth one here, MongoDB. This is one that you actually pitched to me, I want to say like 4 years ago. And for the life of me, I just could not grasp the business. But basically, Here's the headline. MongoDB provides a document database, which makes it easy for developers to store structured or unstructured data. They have grown revenue at 50% a year over the last 9 years, $17 billion market cap. It's down 60% from its highs, and it dropped significantly. It dropped quite far after its latest earnings report. So some cause for concern here on the latest report. I remember growth is kind of flatlining a bit. It sounds like maybe there's a little more competition coming in.
Yeah, that could be tough. Obviously, yeah.
What's
It seems
the
like
operating earnings look like?
yeah, let me pull that one. I did want to, I guess, before I change this one, look at they have their MongoDB Atlas, which basically was a new product back in 2016 or something around there, and it's their cloud-based solution for their typical database. It's supposed to be superior to something like Oracle, but I don't know the nitty-gritty details of why. But it basically went from 0 to $1 billion in revenue in, what is it, 1, 2, 3, 4, 5, 6, 7 years, which not bad. But yeah, let me pull up that operating earnings. Let's see if they're profitable. I'm guessing no. Yeah, this one's ugly like Snowflake. I'm sure it's all SBC and stuff like that. I'm sure they're generating positive free cash flow and they brag about that. But let me pull up maybe. Why don't we just use price to gross profit? That's better. Price to gross profit of 13. That's not terrible if you believe growth can reaccelerate. But if you said that, like, here's the thing about these. If I'm looking at a software company like this, I have no idea why revenue's slowing down. And if you don't have any idea why revenue's slowing down, you can't make any sort of estimates about the future, which would concern me for a lot of these.
Yeah, the other thing is price to gross profit of 13. Most of their costs are operating expenses. It's, I would assume. So
yeah,
it's not even, I think gross profit is very misleading relative to what they could eventually earn. It's nice that they have high gross margins, but it requires a lot of research and development, a lot of developer talent, which is costly. So I'm going to say on this one. We've gotten through 4 here, and I think Veeva Systems is probably the most attractive so far. The 5th one here is Paycom. Now, this is one I'm a little more familiar with. They're a human capital management software provider primarily for small and medium-sized businesses. They help with talent acquisition as well as time and labor management, among other functions. So basically helping run the workforce, helping attract new employees or keep track of new talent as you're acquiring them. I think there's some to like here. Paycom's been around for quite a while. 31% revenue growth over the last 10 years annually.
Yep.
$8 billion market cap, down 73% from its highs.
Wow. All right. Yeah, I'm seeing this one again. I think listeners won't be shocked to see that I'm seeing positive operating earnings, and that actually makes me way more excited about the company. I mean, seriously, like think about these software companies with these supposedly high margins that they like. If you can't generate positive operating earnings at a $3 billion revenue level, like when are you going to do that? I just, okay. Sorry, little rant there, but let's go look at this valuation. Price to sales 4.7. This one's attractive. I remember looking at them. I believe we did a show on them a while back. Wow. In 2021, that price of sales got up to 30. I mean, software was crazy. Ryan, do you remember, like, people were getting 10 baggers left and right. The multiple expansion was crazy. And it seemed like didn't it seem like one of those situations? Were you worried that, like, I felt like this too, like, am I missing something when that multiple expansion just went crazy a couple years back?
Yeah, I started to think software was like these unbreakable models, which just is not. What's the EV to EBIT on this?
Yeah, I was gonna say we can actually use a real earnings ratio here. It looks like 13.5. Wow. I saw some people tweeting about it too, like some kind of value focused people. 13.5. That's not bad.
This
That's
takes the
not
cake
bad.
for me so far on
I want to
most
know why.
attractive.
Why is it down so much? What's happening? Because for a company that chart looks so good, the revenue growth looks so good, the operating earnings look so good. Why is the EV to EBIT 13.5? Because I think people are they must be expecting that not to continue. Why? What did they say? What happened? That's That would be my next question. Obviously, we can't talk about it now, but hey, Ryan, maybe that's the next one you look at for the old podcast here.
Yeah, I could be down to research that one. Sixth one here is Paylocity. We had someone come on and pitch this beforehand, on our show before. Andrew Marshall, he came on, pitched Paylocity. I talked to him. He's actually since sold, but Paylocity offers payroll and tax services to simplify, automate, and manage compliance requirements as well. So basically, it's payroll software provider, and they earn some extra interest income because they hold on to funds for a little bit, which this stock is down 54% from its highs. It has had remarkable revenue growth over the last 10 years, 30%.
Profitable now. Profitable. Yeah.
I think they're earning a lot from that interest income. And
right.
Look, maybe they interest rates could go up from here. It's possible. It doesn't seem like that's what's being telegraphed right now by the Fed. But if rates do come down, it certainly hurts them. Interest income is ultra high margin. It doesn't really cost anything. And so it really helps profitability. The issue is that I'm seeing a lot of these companies do this now. Bill.com is similar, where yes, you are earning interest on their funds. People didn't care about that for a while, but now customers are starting to care because they're starting to look at this and say, okay, they're holding my funds when they're generating interest on it, but I'm getting sick and tired of having these funds held in limbo. I'm going to try to find a solution that doesn't do that. And there are certain solutions to kind of circumvent some of these payroll and billing solutions. And I'm seeing that more and more. People try to get around Paylocity, get around Bill.com, find a cheaper solution. So that would be what I'm a little bit concerned about here. How much is core revenue growing as opposed to interest revenue?
All right, we can pull that up. They do have that for us. Operating revenues. Let's just do quarterly to see recent. Okay, loading. Since June 2021, operating revenues are growing at a 33% annual clip. Doesn't seem like there's been much of a slowdown recently, but I'm sure guidance must have been weak, something like that.
I heard
PE
they
high though.
missed their
41.
guidance, but
yeah, PE 41, EV to sales 5.5, EV to EBITDA 27. Not super cheap either.
all right. I'd say meh on that. Let's move to the seventh one here, Dayforce. This is a company I really had not heard of prior to.
Ticker? What's the ticker? I haven't heard of it
either. DAY.
Dayforce, huh? Haven't heard of this one. Wow.
They also provide HR, payroll, workforce management software, as well as talent management functionality. I'm starting to realize that this is a bit of a crapshoot. It seems like it's a bit of a commodity.
There's a lot of software stocks. Yeah.
Now, it hasn't grown quite as fast. 9-year revenue CAGR is 12%. It's down 62% from its highs, and it's a market cap of $7.8 billion. It looks like they had a huge drop during COVID in revenue.
Yeah, I wonder if you're seeing the share screen here. I wonder if they sold a segment because let me look at just if we go from June 2020. I know that might be a bad comp here and a little bit of a chart crime, but from June 2020 to today, revenue has grown at 24% rate. That's not bad. Let's look at see. Is it profitable? That's just a question every software investor should be asking. Is the company I'm investing in profitable? And they are. Positive operating earnings doesn't seem like much.
What's the trailing? 12 months.
That's quarterly. Oh yeah, that's why it doesn't seem like much. Trailing 133 million and market cap of 8 billion. Okay, not that great. All right.
I'm probably gonna pass
look at the
on this.
sales ratio.
I don't need
Price
to go much
sales
further.
of 5. Just
I'm gonna pass.
Here's a tip that I've gotten heard on in the past, and I make sure to look at because it's helped me like with stuff like Peloton. Look at the definition of operating expenses. Like a lot of stuff, it's not the same for every company. A lot of companies where you go, well, gross margins are 80%. Why do they have negative 20% operating margins? Maybe it's because they're putting a lot of their cost of goods sold within operating expenses. So just look at that definition. It's in all the annual reports. Okay.
Let's move on to the next one here. A company we're familiar with, Dropbox. I think a lot of people are probably familiar with this, compete with Google Drive. It's a file sharing, content collaboration platform. It's actually gotten better at helping teams kind of work together on projects or projects, documents, presentations, stuff like that, and then sharing out of it as well with their acquisition of, I can't remember what it was called. They acquired some company.
Or
No,
DocSend.
DocSend. That's right. However, growth has stagnated a little bit, and frankly, it's kind of flat over the last couple quarters. So a little bit concerning. Generates a lot of cash, has some stock-based comp, though, that's worth kind of taking a look at. They did do a big price hike, which maybe is leading to some of the attrition in paying customers. They have $440 million in last 12-month operating income. The market cap is, what did you say, around $8 billion right now?
7.2.
7.2. So EV to operating income of what, mid-teens?
Yeah, and let me look at total shares outstanding. From June 2021, it's declined at a 6% rate. So not bad. That's not bad. That can help. It's just,
I'll be honest, I was happy when we exited this position.
yeah, we have owned this in the past. It's just tough. They haven't executed that well. They seem to be flailing a little bit with new products. Yes, the capital returns program is smart. They have good cash conversion, all that good stuff. They're reducing shares outstanding by a good amount, but where do new customers come from besides acquisitions? I don't know. It's a little bit messy. Probably works from here because the stock is so cheap, but is it a high quality business? No.
I'm more interested at probably 10 times EBIT.
All right. Yeah.
Which it's a little
Just
bit
given the
ways
buyback.
from. Yeah, I mean, if we're expecting low to mid-single digit growth, margins maybe trend a little bit up. The buyback is there, but when they really reduced share count, they took on some debt to do it initially. So I wonder how much they can really fund to the buyback. They'd probably take down shares, I'm guessing, by like mid to high single digits on a going forward basis.
Let's take a cash and equivalents. Yeah, I mean, it's come down a little bit, about $1 billion in cash left. And liabilities, total long-term debt, a little higher. So yeah, definitely. About net cash of 0 from what it looks like.
Yeah. I'm not interested in Dropbox at this price, just honestly. Let's go Workiva. That is
WORKI.
Yep.
Yep, I got it.
They say Workiva is a fit-for-purpose connected reporting and compliance platform. Basically, I think that just means they help customers individually. It's not like it's a purpose-built solution and not just one out-of-the-box platform where everyone can use it in the same way. 10-year revenue growth, 21% annually, $4.2 billion market cap, down 53% from its highs. Is this bad boy profitable?
I'm going to check. No. But getting better. The visualization helps here. They're moving in the right direction, but still, why aren't you profitable at such a large scale? Price to sales 6.3, not crazy. Yeah, this can work if you believe, or if there's some part of the story here where you think they're going to deflect to profitability and quickly. And remember, it's not just, oh, we have a 5% margin. It's we're going to hit 20, 30% margins, which all the software companies seem to talk about and never actually do. So my guess would be they don't do it because it seems like, what is it called? the base rate on these software companies is they love talking about their margin inflection that doesn't show up except in adjusted EBITDA numbers.
Yeah, I'm probably gonna pass on this bit. This one here. Last one. Let's go EPAM Systems. Now, full disclosure, this is not a software stock per se. It's more just like software consulting. They have a whole bunch
Yeah.
of employees actually a lot of their employees were in Ukraine. And this was a business that grew revenue really quickly. It was a talented tech workforce that was lower cost than what you would get in America. And if you look out over the last 10 years, it's become just a much, much bigger business. The issue is that their workforce was in Ukraine.
Yeah. So the war.
Yeah.
Hit 'em tough.
So it's really affected this business. They relocated a lot of them, but I just wouldn't be surprised if a lot of the projects are being delayed. People are afraid to work with them because the employees are busy, concerned.
Right. Yeah. Yeah. Looks like here them profitable every year since 2014. Enterprise value, it says here, is 8.2 billion. I wonder, that's a lot lower than the market cap. So I wonder if they have a heavy cash position here. If you look at the last 12 months earnings, 575 million. So not too expensive on an EV to operating earnings. And their peak was in the fiscal year 2022 at 713 million. So if you believe that they can get back to that 713 million and keep growing it, well, they could be well on their way to $1 billion in earnings with $8 billion EV. I wonder how they've been on returning capital to shareholders. Maybe they've been hesitant, but yeah, shares outstanding haven't really been moving in the right direction. Actually, the wrong direction. So it could work if you believe there's a change coming here, and they're going to get past this. But yeah, like Ryan mentioned, if they got all their assets in Ukraine, that's a tough one.
Yeah. That's all 10. What would be the most attractive to you?
Let me go through the list here.
There's Snowflake,
Paycom,
Atlassian, Veeva. Okay.
and Veeva.
Yeah, I'd say Paycom is probably number one for me right now. Gonna do some more work on that after this chat. Now, before we move on, want to give another word from our sponsor here. Earlier in the show, you heard us talk about the investing platform public.com. That's where you can trade options with no commissions or per contract fees, and you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. This is paid for by Public Investing. Options are not suitable for all investors and carry significant risk. Full disclosures are in the podcast description. U.S. members only. You also saw us share our FinChat charts there. If you want to get 15% off, use code chitchat, finchat.io/chitchat. Go to that URL and you will be able to get 15% off.
The link is in the show notes. Just use that. You're not going to be able to remember the URL. The link is there.
All right. What do you want to talk about next?
Let's go to some questions people have. Do you guys have any thoughts on Facebook dating versus Match? Facebook dating likely won't work, even if they give a lot of numbers about usage. That's probably just because people click on it. Facebook Meta is a little bit liberal with how they define users sometimes. When they send you an email and you click on it, and that's the only thing you do that month, that is still counted as an active user. Someone says, have you looked at Genk, Genk? To me, I did a little bit. Korean barbecue brand that's trying to grow throughout the US. It could be an interesting one to look at. I didn't want to do it right after Portillo's because I didn't want to do restaurants back to back, but I think I will look at that at some point this year. Other questions. Do you guys think he'll be prosecuted? Nope. Okay. Do you guys think the hyperscalers will slowly create free versions of all these cloud software offerings and just bundle them inside of Azure, AWS, and GCP, similar to what Microsoft did with Office? Yeah. Look, I look at all these and I say, at the right price, of course, I'd rather on the cloud. Those three companies. All right.
Yeah.
Okay. Other ones.
But it's wrapped up in something bigger.
That's true. That's true. Right. Where you kind of want one of those situations where people talk about AWS for free at Amazon, right? Those situations make sense, or when no one was counting on Google Cloud to ever be profitable, stuff like that. Anything else on that, Ryan?
No, the hyperscalers are just such an awesome business.
It's a good business. It's a good business. Let's see. Do you guys think the bank, is that the Bank of Canada, BOC, and the European Central Bank cuts could lower U.S. inflation rates due to more goods being produced overseas? No clue, and I don't care. Sorry.
Yeah, I'm sorry, I don't know. No idea.
All right, let's look at a few. We got a few on Twitter, so let me look at those as well. See if we got any. I know that sometimes they're not the best questions, but I want to look at, I don't know. People are trying to interact with us. So they say, is Paycom worth the risk with the pullback, or are there better options in that field to invest? Hey, all right. We already talked about that. Lamb Weston seems like an interesting play with their drop due to CRM software changes. Okay, what SaaS and expensive tech / expensive stocks would you buy at the right price? All right, Ryan, maybe that's a good one for you, both of us. What software stocks would you buy at the right price?
Well, I got kind of a loud noise going outside my window, so I apologize in advance. But there are a lot of software stocks that I buy at the right price. I want one that matters a lot to the customers and not something that's like a super competitive space. Something that's hard to replace, like an Adobe, just because of the bundle there. Autodesk, kind of the stuck with it for life type of softwares I really like.
Yeah, I'm trying to think of all of them off the top of my head, but yeah, the Autodesk makes sense. We had a comment here that says CRM. I mean, Salesforce does make sense at the right price. If the thing is, a lot of these management teams they have not cared about shareholders for 10 years, and it didn't matter because, or even longer, 15, 20 years. They did not care about shareholders, but it didn't matter because the growth was so strong. When you're growing revenue at 15% a year for a decade, no one cares that you actually don't treat shareholders properly. But now that might start to matter as these businesses mature. Trying to think of other software. There's just not that much that I like. MongoDB made a little bit of sense to me because I was read a lot about how it's different than Oracle, but then I saw all the cloud providers copied them, as we already talked about. Someone said Shopify. I think that makes sense a lot. Reminds me again, Wix at the right price, I think makes sense because you can. It's not like you can predict it, but the reliability of the existing customer base is fairly predictable as long as they don't botch things with new product rollouts. Because they're going to stick around, and there's going to be some churn, but it's not going to be high, and there's cash flow coming in.
Intuit, maybe.
Someone did say Intuit. Now, FedNow, what's it? The direct thing is growing, but we'll see. We'll see. All right, let's get off software. Too much software for one company. Or sorry, for one podcast. Why don't we talk? Here's one I thought was interesting, Ryan. This is a fun fact. Now, this is Ryan. Maybe we're gonna save your debut if we don't get to it till for this new segment on microcaps and small caps until next week, but that's okay. But I have my winners and losers from the week. I'm gonna try to do this every week. First one I have here, winner of the week, is Never Sell Investors. David Gardner, this one is right for you. Here's a pullout from a Lindsell Train report, something. I read it. It said, as of the 2006, when this work was published, if you bought the original S&P 500 at launch in 1957 and then did nothing, you'd have beaten the actual refreshed S&P 500 by more than 0.5% per year. Good. I wonder how much Philip Morris was in that, Exclude Philip Morris, what do we do? But it forced you to hold the biggest winner of that time period. So I think it's quite interesting where forcing yourself to never sell, or at least understanding that this can happen, can keep you from being too active in your portfolio.
You think there's any situation where you would just buy the index and just that's it?
Not my whole account. No, you talking about I don't know, like a little bit of the account maybe, but the whole account, no. Or my whole retirement, no.
No, too boring.
No, and too boring. Also don't like the risk of the passive bubble people being right, because I think there is. I know it's not a black swan because a lot of people talk about it, but it is maybe a white swan. Not to anger Taleb there, but I do, and plus the market's at 30 times earnings.
Yeah, it's a little outrageous.
Okay, we got people in the comments saying they want your segment, Ryan. They don't care if we go over an hour. So why don't we?
Let's wait because I still got this noise in the background. So
All
talk
right,
through
I'll do
the
my loser of
president
the
from
week, and I
Mexico.
should say, any listeners, tell Ryan if the noise does anything, because I never hear it, so I don't think it's actually picked up. And yeah, okay. Let's see. Oh, my loser on the week. This is a fun one. Berkshire Hathaway, buy the dip. People, did you see this? Where there was a glitch and the A shares traded at a 99.9% discount for a small moment there. For those that don't know, the A shares trade at like $600,000 because I've never done a split, but you can buy the B shares as an individual to, if you don't have $600,000 lying around. And according to the New York Stock Exchange, they said traders who scooped up Warren Buffett's Berkshire Hathaway shares at a massive discount during the glitch will have their deals canceled by the New York Stock Exchange. They're just ruining us value investors' lives. We're just trying to buy the dip.
What about this new exchange?
The
You hear about
Texas
this?
Stock Exchange.
It
Yeah.
actually kind of makes sense to me that for someone to try something like this, just because I'm not very fond of the idea of like exchanges exerting too much power. Well, okay, in this case, it makes sense, right? Someone that said they're going to sell at market order and it was $700,000 or whatever, and then the next day it's down 99% because you messed up, you would be screwing over those customers in a huge way. So that makes sense for any of those orders to be canceled. But some of this other stuff, like setting requirements for like board diversity as the
Right.
exchange, I just don't think that's your role.
Right. Exactly. Yeah. There's some jokes to be made here, Texas Exchange is gonna, I don't know, because, it's like, because woke things. But yeah, look, there hasn't been a competition for a long while. New York Stock Exchange, NASDAQ, OTC markets. It's pretty much all there is out there. I remember like 5 or 6 years ago, they were trying to get the long-term stock exchange going, but I don't know if that's actually.
I think
It's
they
kind
have
of
2
like that
active
Be Real.
listings.
It's like that Be Real social media one where it's like, just come on one a day or one time a day, and it's like, well, how are you making any money? But hey, competition is great. Let's see if it works. I thought what was interesting reading it though is that Citadel and the other market makers were part of the backers here. So I feel like the market makers, and I don't think they're evil, but I think they're trying to consolidate their position and earn a little bit, get a better competitive edge in this space.
Yeah, it's certainly possible. All right, let's do this section. New segment for anyone who's made it this far. I guess you earned it. Thank you for listening this long. I'll re-announce this next week probably, but my goal is to research one smaller microcap stock every week that I find interesting. So microcap of the week, I'm going to call it microcap, but basically the goal is that it's like $500 million or less. I don't know if that's really microcap, but that's $500 million market cap or less.
You could do a fun meme about, like a microcap used to be $100 million. Now it's $500 million. What happened to the country I used to know? Like those
Yeah.
Chipotle ones. Yeah.
Yeah,
But
that's true. Yeah, if I think of something good there, maybe I'll tweet it out. But for the time being, yes, microcap of the week. That is the new segment. I'm going to try to do one every week. The stock for this week is Goodhart Wilcox. They are an educational products provider that specializes in career and technical health and PE subjects. So note that is not the most competitive or the mass market textbook subjects like math, language arts, science. It's kind of the more, like I said, technical stuff. And they're making a transition to digital. So COVID kind of forced their hand a bit here, although they already had some efforts going on. But the companies, here's a quote from a new investor, hedge fund manager that I started reading his letters, and he does a wonderful job. He says the company's digital, no, it's not going to be on there. Brett's sharing his screen. It's not going to be on there. I'll explain why here in a second. It's yeah, the latest they have is revenue from 1998, I think. So I'll talk about why in a second. But the company's digital revenue started to gain significant traction in 2018 and have only accelerated further post-pandemic. They now make up almost 40% of revenues and still grow 35% per year. Operating margins are now 30% and climbing, and cash is quickly piling up despite paying a large special dividend at the end of 2021. And they pay out the majority of their net income as a dividend. So I guess the interesting thing here, they don't have an investor relations page. They don't file with the SEC. They have their financials on OTC markets. I had to email their investor relations to get updated financials. So it's a pain, but it looks like a pretty solid business. This digital revenue is more recurring, so it's less cyclical than this business used to be. They pay out a ton in dividends, and it's really run like an old school company where the CEO writes a letter every year just describing the progress in the business, what he likes, what he's seeing, and they return a ton of cash to shareholders. I believe it's around a 6% dividend yield, but the business is actually growing. So I like it. The other good thing about businesses like this is when it's almost run like a family run company, they prioritize shareholders because they are shareholders. So they just pay out the dividends. And it feels like you're maybe blending some growth here with steady capital allocation, which I really like. The ticker is GWOX. It's up a lot in the last year, but I just kind of like some of these that are trading with completely irrespective of what's happening in the market.
Yeah, and it's interesting. You can't really get it on a screener, right? Because it's not going to show up there. And the digital, I'm assuming it's just digital textbooks.
They still have traditional textbooks too. That's 60% of the revenue.
Okay, but the digital is digital textbooks.
Correct.
Okay. And what kind of earnings ratio are we at right now?
I believe it was low teens. The thing is, they do like billings now because they order a lot up front and it's like amortized over 7 or 8 years, but it doesn't really cost a lot to serve. So, the revenue is recognized over 7 or 8 years, I think.
Free
And
cash flow could be higher.
yeah, I saw something that it was trading at like 3 times free cash flow. So the issue here is that it's super illiquid. Like if you go to the 1 week price chart, nothing's happened. You have to, I'm sure the commissions are fairly high to order this if your broker even allows it. So not an easy find or an easy buy.
Yeah, and I guess that's a good question as we wrap things up here. Maybe final question on this before we get out of here. What is you're saying you're going to do one of these a week. We'll hold you to that. Listeners will as well. Get on Ryan if he doesn't. What is your planned research process? Because I know one of maybe the almost most important thing within small and micro caps is how the hell do you find them?
Okay. Yes, that is the biggest thing. First of all, I was looking for a modern Moody's manual. There really is not much. You can maybe do value line, but it's hard to do, or it's expensive.
Talk to FinChat. You know, maybe talk to the team there. You guys could do something.
Yeah, it's a number of different things. So Microcap screener I've been doing. There's a couple of accounts I now follow on X or Twitter that do a really good job. And because they've been following them for a long time and they're new to me, I'll have some easy ones to pick up here. Value Investors Club, and then a lot of hedge fund letters you can find. There's a couple of hedge funds that are just purely micro cap hedge funds. which are just easy to find and they have good write-ups on them. So that's probably going to be the bulk of where I find these. I've got a few already on the docket for the next upcoming weeks.
All right, beautiful. Yeah, I was gonna say that's good. I think honestly, this takes a lot of time too, but doing a screener of I know not all of them are gonna show up, but just for tiny size, and then you got to go through each one because the numbers are probably not going to be that good compared to the large caps. But yeah, not bad. I think it's a
There
fun
are
topic.
a lot of ugly ones.
Exactly. You have to find the diamonds in the rough. And what's the classic saying? I'm not coming up with this on my own here, but a microcap or a small cap doesn't always want to be that small. So there's a reason it's small. They probably struggled for a long time. And a lot of the managers there have minimal scrutiny from the news, whoever, from anyone. There's probably just a few analysts and shareholders that follow them. And sometimes they act, as we've seen, not too ethically sometimes. All right. I think that's it. Ryan, anything else before we close out? I will say, Tyler said here in the comments, I don't hear it's quiet for me, especially when he talks. So I don't think the listeners pick up that noise.
All right, let's wrap this thing.
All right, let's get the disclosure. We are not financial advisors. Oh, actually, before we haven't said this in a while. If you like the show, give us a review on Spotify or Apple Podcasts. We really appreciate that. Best way to grow the show. Best way to support us. Follow us there. These go live every week, Thursday morning. Well, on the West Coast, about Thursday noon Eastern time, 12:30 on the YouTube channel. You can watch them there, watch the replays there, or listen to the replays on Spotify or Apple Podcasts. And the best way to do that, again, is to give us a review on Apple Podcasts or Spotify. But let's hit the disclosure. We are not financial advisors. Anything we say on this podcast is not formal advice or a recommendation. Ryan, I, or any podcast guest may hold securities in this podcast, or excuse me, not in this podcast, talked about on this podcast, may have held them in the past and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, and we'll see you next time.